History as it happens, June 1st, 2021. Bitcoin, boom or bust?
Bitcoin plunging by almost 30% to $31,000 earlier today, raising all of its gains since Elon Musk.
I wonder if you've been rattled at all about either Fed speak about crypto or Elon Musk's
but
tweets.
Ether is outpacing Bitcoin by about triple this year.
Let's talk rocket ships. First, Bitcoin. That falls into that category because that's what that is. 39,000. Where's it going?
Where is it going? It's probably going to 100, then 150, then 200,000.
I've seen you take to Twitter and call this everything from a failed currency to an open Ponzi scheme.
Depending on whom you ask, crypto is either a speculative bubble or a revolutionary currency. Or you might get this instead. What is Bitcoin? Well, we can't afford not knowing how to answer that question any longer. Whether it's Bitcoin or total return swaps or hedge fund short sellers, our financial system is filled with minefields again. That's next as we report History as it happens, a podcast from the Washington Times. I'm Martin DeCaro.
I can assure you, my friends, that it is safer to keep your money in a reopened bank than it is to keep it under the mattress.
When FDR broadcast his first fireside chat, encouraging Americans to trust their banks again, it worked. When the banks reopened 8 days after FDR had declared a bank holiday to stem the month-long run on savings accounts, people lined up to redeposit their hoarded cash, and the banking crisis of 1933 was over.
Another question that you will ask is this: why are all the banks not to be reopened at the same time? The answer is simple, and I know you will understand it. Your government does not intend that the history of the past few years shall be repeated. We do not want and will not have another epidemic of bank failure.
And we'll thank C-SPAN for the crackly radio address from the archives.
People will again be glad to have their money where it will be safely taken care of.
So today, you probably trust your neighborhood bank. If you deposit, say, $1,000, you can be sure it'll still be there when you need it. The New Deal era FDIC insures your money against a bank failure. But what about the big banks, Wall Street? Do you trust them? Do you trust federal regulators are doing their job so we can avoid another crash like the one in '08? And what about your 401k? You know, you can do everything right. Invest your money wisely. Don't touch it until you retire. But what if cryptocurrencies start working their way into retirement accounts? People who say Bitcoin and other cryptos are merely Ponzi schemes wouldn't want them in their nest eggs. And back in early March, do you remember the $20 billion blow-up known as Archegos Capital Management? You know, I'm still a bit astonished this story didn't get more attention. Archegos, run by Bill Hwang, exploited a loophole in the Dodd-Frank Act to make billions of dollars, until he didn't. So Hwang lost everything, and Credit Suisse, to name one bank, lost $5.5 billion because of one bad trade. So it's no wonder so many people still think Wall Street is festooned with scam artists who are exploiting legalized forms of gambling with other people's money without producing anything of real value. So let's talk about why our financial system is still this way, why speculative bubbles happen, why they've always happened, and why we can't afford to have short memories. Not trying to be dramatic here, but 2008 wasn't that long ago. Benjamin Friedman is a professor of political economy at Harvard University, where he has taught since 1972, and he's the author of a fascinating new book, Religion and the Rise of Capitalism. Benjamin Friedman, welcome back.
Thank you, Martin. Delighted to be back with you.
Yeah, good to see you again, speaking to you on Zoom. And our listeners, of course, remember you were on the podcast earlier. We talked about the problems with American capitalism, and I suppose one of those problems is the subject of this discussion, our financial system, and the rise of cryptocurrencies and speculative bubbles. What's your take on cryptocurrencies and their volatility? These currencies have been around for about 12 years now.
I think there are two dimensions of the cryptocurrency issue. One, let's take seriously the word currency, that this is something to be used by individuals or businesses to pay for something. The fact that the price gyrates so wildly is clearly a mark of something that nobody would want under ordinary circumstances to use to pay for anything. here's this thing, and it was trading above 60,000 just a couple of weeks ago. Now I looked this morning, it's in the 30s. This is losing half of its value. Why would you want to use dollar bills if you thought the dollar bill in your pocket was going to lose half of its value in a couple of weeks? So there's got to be something strange about this idea. I don't believe that anybody would use these so-called currencies for payments unless they're doing something that's criminal. So, for example, the malware that shut something down a couple of weeks ago, they presumably got their payment in something like this. So for that reason, I think because it's abetting criminal behavior, it's a big problem. And then it's a problem because people are speculating on it. They're not treating it as a currency. They're treating it like a Rembrandt painting or oil in the ground or something like that. They're just buying it on the hope they'll sell it to somebody else for a higher price. And as long as not too many people do it, if they lose money, well, that's their affair. The risk to the rest of us is that they do it in a way that impairs the financial system, and then we've got a big problem.
Well, it seems one of the problems here is just figuring out how Bitcoin and other cryptocurrencies would actually work. What can you buy with them? Tesla announced it would accept Bitcoin as payment for its cars, and then Elon Musk changed his mind. So are we looking at a future where I would say walk into the grocery store, maybe pay for my groceries with a $100 bill, or I could take out my smartphone and, hook up a cryptocurrency, pay with Bitcoin or something like that?
Well, to begin, we're already in the world in which you can take out your smartphone and pay. And if I walk into the store and want to buy something, depending on what store, maybe I'll hand them a green piece of paper, maybe I'll pull out my piece of plastic, and maybe I'll pull out my phone. The question is, under what circumstances would people want to use something that's a cryptocurrency instead of the currency that's already electronic and goes through the banking system in the usual regulated way? My concern is that the crypto part of it is precisely aimed to enable people to do things that are criminal, like hold up firms to ransom, like make payments that they want to keep outside of the regulatory scope, like engage in transactions that will then enable them to escape taxation. All of these are criminal violations. And the question I think you have to pose, given that we already have the convenience of all of the things you just talked about, why would somebody want a cryptocurrency instead of just being able to pull out your smartphone the way you already can?
Do you believe it's inevitable that there will be some kind of federal regulation for the crypto markets?
I'm guessing there will, but the question is not so much whether there will be a regulation. Question is whether the regulation will be effective. There are lots of things that take place that in principle ought not to take place or ought to be regulated, and it doesn't. In a bit, it's like asking, do I believe there will be federal regulation of the numbers racket here in Boston? Well, they're perfectly free to put in regulation, but it's hard to see how it will be effective because of the hidden nature of this. Or it's like saying, shall we have greater regulation on all of the drug dealers? Well, in principle, we have a regulation. It says you can't do that. That regulation doesn't do very much because it isn't effective.
I'd like to return to one of your earlier points about Bitcoin as a speculative asset. I guess that's another way of saying gambling. I've said that if a friend of mine wants to throw $1,000 into Bitcoin to see if he makes some money, then fine. But there's a growing concern that as Bitcoin crashes, it pulls down other assets. Companies are putting Bitcoin on their balance sheets. And there's a concern it could start creeping into people's 401ks, their retirement accounts. What are your concerns there?
I think people should not unawares be caught exposed to these kinds of things. So if somebody who knows what he or she is doing wants to invest a 401k plan in part or even in all in Bitcoin, more power to them. They're welcome to do that. The issue then is what happens if a bank does that? Should we have regulations saying that banks can't hold on their balance sheets more than a certain amount of cryptocurrencies? The answer to me clearly is yes, in the same way we have regulations that control all sorts of things that prevent banks from being too risky. Banks can't put their funds entirely in equities. They can't put their funds entirely in the debt of one particular borrower. There are all sorts of regulations of what they can do. And depending on how wildly the prices of these assets tend to fluctuate, I think we should have rules for banks saying the maximum amount of the balance sheet that they can put into these instruments. The real question is, what about all of these entities like hedge funds, like so-called shadow banks that aren't subject to federal regulation? What happens if they overinvest in something like cryptocurrencies? They go bankrupt, and all of a sudden their liabilities, which other people had been treating as perfectly good assets, turn out not to be good assets at all.
Well, that takes us to the bigger picture that I want to discuss here, the nature of our financial system. Since '08, since the crash, I've had the sense that we're careening toward another disaster that no one can see coming. I don't want to say that we're always in these types of situations, but do you believe we're in a minefield and it's just a matter of time before we step on something?
What we do know is that from time to time there will be financial crashes. It simply happens because of the nature of speculative markets. But you talked about more than just a crash or a dip. You talked about a disaster. And the answer to that is we do not know. I would be skeptical that we would have a disaster because we're protected today in a way that we weren't in 1932, 1929. We now have deposit insurance, so people are not going to lose their money when banks go under. We now have bank regulation that we didn't have then, so banks are not going to fail in the way that we did. We now have margin requirements so that most investors, unfortunately not all, but most, can't borrow against stocks the way they did in the 1920s. One could go on in this vein. So I think we are protected in ways that we weren't. And I'm optimistic that that means that when we have market downturns of some severity, the way we did in 2007, 8, 9, the way we did before that in 1987, the way we did before that in, say, 1974, it's not going to turn into an out-and-out disaster like we had in the 1930s. But the point that you also made that I think is very valid is that when crashes come, they mostly come from something we don't know about. Crash coming from something that everybody's been keeping his eye glued to doesn't happen too often. Usually it's something we're not thinking about. And today, to me, the real risk is that so much of this investment activity in the market comes from shadow banks, hedge funds, and other investment entities that stand outside the regulatory umbrella. So that when I said a moment ago that most investors are not able to borrow up 90% of what they're investing, that's true for most of us. But there are some kinds of investors who, by taking advantage of instruments that are outside the regulatory purview, can do just that.
So along those lines, let's talk about something called a total return swap. It's a type of derivative that provides, as one article put it, the economic benefits of owning a stock without requiring the person to spend the money to actually buy it. And the article I'm reading is about the Archegos debacle, Archegos Capital Management, which blew up in March. This was a family fund, so it was operating outside the regulations established in Dodd-Frank. And to make a long story short, and to stay out of the weeds best we can, essentially Bill Huang was running Archegos, and he was borrowing money against the value of his portfolio. So he was highly leveraged, and his bets were doing great for a while, until they weren't. He made one bad trade involving Viacom CBS stock, and he lost everything. Several banks that were not aware of what he was doing because he wasn't required to disclose the stocks he was invested in. Because of one bad trade, these banks lost billions, and they were forced to liquidate assets, or they could have lost billions more. So when I see something like that, I get concerned.
Well, I think you're right. And then the question is exactly why should we be concerned? So to start at the beginning of the chain of events that you described, should anybody be upset that this one individual lost his shirt? My answer is no. Tough kazoo. Who cares about that? Second, several banks lost an enormous amount of money because they had lent far too much to him without understanding what he was doing. Now, should the share owners of those banks be concerned about that? You bet they should. Should the rest of us be concerned that Credit Suisse, which is the main bank involved, lost a lot? Well, I think this is very tricky. If Credit Suisse had enough money in it that they were at risk of failure, then yes, the Swiss banking authorities absolutely ought to have been concerned. If Credit Suisse was simply going to take a huge loss at the level that the stockholders came close to getting wiped out, well, it's not my problem. It's not yours either. Think of Citibank in the last crash, for example, in 2008 and 9. Citibank stock went from $55 to 97 cents. Well, if you or I had been shareholders of Citibank, we might have been mighty upset. But should an ordinary citizen be upset that share owners of Citibank took a big hit? It's not obvious why. And then we get to the third thing you said, which I think is now getting very important. If enough banks are invested in the same kind of instruments and have to be liquidating other instruments at the same time, that can create a market panic or crash. And I think that's the level at which we need to be very concerned. And that's precisely what effective bank regulation is supposed to solve.
A New York Times opinion piece said there are more hidden whales like Archegos that could sink the economy. Do you share that concern, or is that overstatement?
I think it's almost certainly true that there are more of these waiting to happen that we have not observed. You correctly observed that Archegos was in principle a family firm and therefore outside the regulatory apparatus. It's surely not the only one, and it's surely not the only one that's engaging in this kind of risky behavior. The part of what you said that I'm not sure is right is whether it's going to sink the financial system. We simply don't know. There will be market crashes. They happen from time to time, but we haven't had one that would sink the financial system since the early 1930s. But the financial system is always innovating. That's what people get paid to do in these firms. That's what their high-priced lawyers get paid to do. They're always innovating and finding ways to put themselves outside the regulatory network. And an aspect that we haven't talked about just now is the fact that these markets are international. We've been speaking as if the United States is the only country on the planet, and therefore all that matters is making our regulation in the United States as effective as it can be. But we have investors in our markets who are domiciled in the Cayman Islands. We have investors who are domiciled all over the world. And so there's an international dimension here. And what we have to avoid is a kind of race to the bottom in which every country is eager to attract the business. And how do you attract the business? You compete to see who can have the most lax regulation. I think so far we've been pretty good at avoiding that, but it's a risk out there waiting to happen.
Well, that raises a question that hangs over all of this, and that is, what are these people producing that's of value to society, other than billions for themselves?
The answer to the part of your question about what these people are producing that's of economic and social value is approximately nothing. It's very important in a capitalist-oriented economic system like ours to have many investors doing their own research and making their own decisions and trying to gain as great a return as they can individually and collectively, therefore allocating the country's capital, the economy's capital. But as to all of the innovation that people are doing in the financial mechanism itself, most of which is devoted toward trying to find new ways of taking risk that should be regulated, or new ways to find their firms wholly outside the regulatory framework, there's no value added of that for the economy as a whole.
Let's talk about the Federal Reserve Board for a moment. It is also being criticized for taking on too much power, pumping too much liquidity into the economy and the markets. How do you feel about that?
Yeah, I disagree with that. I think the Federal Reserve has behaved in a superb way in the current situation. Here we are faced with virus pandemic, which we now hope is winding down, but which had the risk of putting the economy down to a depth that we were unable to see. And in fact, the economic damage was mostly limited to the first 6 months or so. Now we're recovering very rapidly. I think the Federal Reserve deserves enormous credit for what they have done. Now, could they make a mistake going forward? Yes, they could. They could maintain interest rates too low and therefore the monetary policy too expansionary for too long. But I think so far, I would not criticize at all.
So all of these issues we've been discussing here, they have cultural and political implications as well. At this time in our history, many Americans have lost faith in our institutions, Wall Street included. And when they read stories about Archegos or simply remember what happened 13 years ago in '08, it contributes to that loss of confidence.
I think you're right, and it's a kind of catch-22, because here you and I sit talking about various lacunae, lapses in the regulatory system. And somebody else's reaction might be to say, look, here was an example of how the regulatory system failed us. And therefore, the implication the person draws is not to tighten or reinforce the regulatory system, but to junk it altogether and not to try. Now, I think that's exactly perverse. I think that's moving in the wrong direction. But as a cultural, political, social matter, I think you're exactly right in reading the American public today. There are many people, unfortunately, who do and will have that reaction, but this doesn't mean that they should prevail.
When it comes to effective financial regulations, I often reflect upon the New Deal, and I have spent time on this podcast recently discussing the New Deal and its legacy. In the early 1930s, those new regulations made the American financial markets really the envy of the world for their transparency and predictability. Do you agree with that?
Yes, in some respects they did, but in other respects they didn't. So to take one example of a rule that we had in place during the 30s and right up until the 1970s and even into the 80s was a prohibition on interstate banking. Citibank could not open an office in Chicago, for example. Bank of America couldn't open an office anywhere outside of California. That may have made the United States a safer financial system, but it certainly was not a guideline to elsewhere in the world. Nobody else copied that in any major way. And eventually we got rid of it ourselves. So there were some things in which we were pioneers. To take one on the other side, I think our move toward deposit insurance at the federal level was a terrific move in the 1930s. Just think of it, back in the 1920s and in the early 30s, when all those banks were failing and individual Americans were losing their money, their personal money, when the banks failed, there was no deposit insurance. That was put in place as part of the New Deal. That was a terrific idea. So some things that were put in place were great ideas and others less so.
All right, Benjamin Friedman of Harvard, we thank you for helping us understand what is often an opaque, arcane world of high finance. And one of these days, I may eventually understand Bitcoin. On the next episode of History as It Happens.
Diplomacy is back at the center of our foreign policy.
After 4 years of Trumpian chaos, Joe Biden is trying to form his own foreign policy. From China to North Korea, from Russia and Iran to the EU and the crisis at the border. We'll go around the world with the Washington Times' Guy Taylor, next as we report History as It Happens, a podcast from the Washington Times.